Well, excited to have this. Unfortunately, we do have one that was sick. Brian Brooks was going to join with us today too, but unfortunately, he is not. He is taken ill, so he is not going to be able to join us. But we have a fantastic panel, all representing different areas of the prudential regulators, as one would say. But I wanted to start off this morning or this afternoon for what we heard this morning. And that was Director Chopra from the CFPB announced an open banking rule. And this was, Raj, I'm sure you worked on it at some point. This was 13 years in its making, and to try to get the U.S. Into a system that many other jurisdictions already have. And, you know, I've watched the coverage. We had some banking trades immediately, come out a little bit more negative. Others have come out more positively, especially those in the fintech who believe it is a game changer. Would love to hear from all of you all. Maybe Raj, start with you. Just what is the impact of this, and how transformational may it be for the U.S.?
It may be transformational, but before I get to that, thank you for the invitation to be here again. And Penny, I would thank you for moderating this, but with Brian's absence, I think this is going to be a lot easier for you to moderate. So I could do that. The Reserve Bank of Philadelphia, for me, is a special place because as a public person, as a public servant, this was the first place that I ever spoke publicly. Bob Hunt hosted that Payment Center conference for years. Less good of a memory, I suppose, is my first talk as the acting head of the CFPB back in 2011, which was next door at the National Constitution Center, in which I suffered maybe the most humiliating experience that a speaker can possibly suffer. And I will not share that now, but catch me at cocktails afterwards, because believe me, it is so cringeworthy, you will require a drink. As to 1033, it has been a long time coming. But maybe appropriately so, because I think the stakes are quite high, and there are way more ways for it to go poorly than for it to go well. And so I'm glad now to finally have the final rule in place. To me, this is important, at least in part, because it is the continuing of, in my opinion, a right-minded unbundling of a lot of the sine qua non aspects of being a bank. So I think about, like, what makes a bank anyway? Well, it's privileged access to leverage through FDIC insurance. It's privileged access to the payment rails. It's privileged access, in the miracle of our federalism, to choice of law. And historically, it really been privileged access to otherwise completely opaque information about your customers. And it's this last part that 1033, I think, really could democratize. And it will make a big difference to some customers, especially those who are not especially structurally suited to be well served by banks. And so I'm optimistic about what this may bring. I'm sure that there will be problems that will arise, but I have every confidence that we can tackle them as they do.
And one of the things that Director Chopra mentioned was that portability. If your bank isn't providing the rates that you want, you can now change. You can shop around. But there's other things that are also what we see potentially of value add too. And Tim and VCQ, Randy, talk about the other aspects of kind of where you see this now codified rule, because it had been in existence or people had been practicing an open banking type of protocol, but what are some of the other applications that you might see come from now this codified rule?
Well, look, I think it is, okay, there we go. I agree, first of all, it can be transformational, but I think the big caveat, maybe some more important than really other applications, is the implementation of it, right? Because that's going to be very complicated. And, one of the things I think we all know and have experienced is the challenges of the U.S. system because of the fragmentation of regulation. And this rule, while it's a CFPB rule, there's going to need to be coordination with the bank regulators in terms of how it's implemented, so that you develop standards for who's responsible for what, who's liable for what, how does that fit into third-party relationships, how does it fit into overall regulation. And the thing we're still missing, I think, in this country is an overall kind of government-wide commitment, and those are not easy to come by, that we want to see innovation in the financial sector, and our regulators have to be on kind of the same team to make that happen. So that's what worries me about all of this.
Yeah, just a couple of comments. I mean, with respect to the rule, my own view is, as Zhou Enlai famously said about the French Revolution and whether he thought it had been a success, that is too soon to tell. And I think that's certainly true of this because of the complexity of implementation. The support for innovation is absolutely something that the U.S. government should be all in on. Whether this will actually do that, I think, is open to question. It will depend on implementation. Have you undermined the incentive of institutions that currently benefit from the collection and use of data to gather that in an efficient way? It's fine for it to be portable. If it's not really existing, if people don't have an incentive to actually develop the use of that data for customer services, that could be a negative. So I'm very open-minded about it, but I think it's too early to declare that this rule itself will be a victory for what it's seeking to obtain.
But do you fundamentally agree that consumers should have rights to their data and that they should be able to control, or do you think that should be centralized more to the, as they say in this conference often, the TradFi and others, traditional financial institutions that have held or at least have a govern on it?
I would say that I'm conflicted about that because of the implications for what it means for innovation. Certainly, I think that there should be restrictions. There should be governance of the use of data that's gathered about individuals. Whether the control of that data should be, fundamentally and purely, when the data has been generated by others, purely in the control of the consumer. Again, I'm very open to that, but I think that experience will tell us whether that in fact is beneficial to the consumer or not.
There are other elements that only experience is going to give us a read on. So, for example, if one believes, as I do, that part of the point of commercial banks is the miracle of maturity transformation, it's all well and good to say, wouldn't it be wonderful if all deposits were, instantly portable wherever you wanted? Maybe, but the way in which one thinks about liquidity management probably looks pretty different in that world, and I'm not sure anybody really knows exactly how it will work.
And Tim, you did speak to the innovation and that you're always trying to find. We always, that balance between innovation. Where does innovation stop and regulation begin, and where does that elasticity, like on an accordion, do you squish it and it all comes out, or do you go wide? What do you think, just in your role or in your past role, what is that balance? And you at the CFTC in particular, dealing with, I would say probably more so on the forefront of the DeFi and the blockchain and some of the more emerging technologies coming in.
Well, look, it's always a challenge because regulators are always lagging behind. That's just the nature of it. And so, the question is, you're reacting from the laws as they exist today to something that's either outside of your purview or maybe on the fringes of your purview, or is kind of, pushing the envelope quite a bit. And your job, you're there for a couple of years, and your job is basically, I don't want to have something blow up on my watch, right? That's what you're thinking about. I don't want to be called in front of Congress for some massive problem that, occurred. And yet at the same time, maybe you do recognize that, innovation is important. So how do I deal with that? So that's the challenge for all of these agencies. You've got a limited budget. So, how do you do that? And that's why I say we need to somehow develop more of a culture that regulators should be able to take risks. Regulators should be able to factor in, the costs of the old system, if you will, the costs of not moving forward, And we're not, we're not there yet, because it's so easy for someone in one of these jobs to, allow something that then causes a problem and then get hauled before Congress and, get lambasted.
Should regulators then be subject to the hiring, firing of a president? Should they be more independent? Should they go?
It's not so much about the hiring and firing. It's more, it's more, how do we develop an attitude that recognizes that, look, innovation is kind of key in lots of areas, but particularly in the financial sector, and technology in particular. Technological innovation is very key. And so, how do you somehow introduce in the calculus of regulation more that, or how do you weight that a little bit more in the calculus of regulation so that you're not, so inclined just to say no?
Well, and I think we have seen that recently. We do have chairman of the FDIC, I think, has had a particular agenda especially on the bank fintech partnerships with non-banks in particular, higher consent orders going to those banks that are involved with fintech services. And now we have 4 rules coming out that are reopening broker deposits, having an RFI on what is a bank fintech partnership, a whole host of questions around what has been the U.S. system of, if fintechs, non-banks want to innovate and have a greater access, they need to partner with the bank. And now that's being called or being asked, is this the right system? Roger, I'd love to get your point and all's viewpoint. Are we at an influx of where we are for bank fintech partnerships, and does that model need to change?
Well, we have 2 choices, I think, in terms of how we want to think about bank fintech partnerships. If we want to continue to have the same chartering and licensure regime as we have today, we better find a way for banks and fintech firms, by which I mean technology obsessive non-banks, to be able to work together well. Period, full stop. If we had a non-depository charter at the federal level that gave you access to the federal payments rails, maybe I wouldn't feel that so strongly. And by the way, it's not just conjecture. If you look at, I think Aaron referenced the FDIC's chart on the number of unbanked households. A surprisingly large fraction of the net reduction in unbanked households is due to bank fintech partnerships. Like, that actually has happened. I would like to think that the fact that those partnerships have been the focus of a shockingly large fraction of recent consent orders is because the rest of the industry is just awesome. Like, everything's just fine. I think that's probably not true. And I think part of it is sort of a maybe predictable consequence of creating a debit interchange arbitrage that benefits a bunch of very small banks that suddenly are working with very important non-bank partners. So maybe we should have thought that through ahead of time.
Yeah, I think we should view the partnership between fintechs and banks entirely positively. It's somewhat, I do find it somewhat mystifying that that there would be this reaction to it in the current regime. I think that you get the best of both worlds. You could have a system that Raj described where you create a non-depository federal charter that allows a lot of bank-like activities for non-banks. But it would then be very hard to draw the line as to, well, what part of the burdensome armature of federal bank regulation do you not apply to these institutions that you are giving increasingly bank-like powers? And I think the current system makes it fairly easy, which is you're not a bank. You can do this. You can partner with a bank, which is subject to the whole panoply of regulation. And that is good for the system. It's good for the consumer. We should be supporting that.
But you heard on that last panel that, especially in remittances and other ways, not having access for a non-bank, not having access into the Fed service, the costs are higher. You're paying middlemen throughout the entire journey or throughout the path. is there, and we've heard Undersecretary Nellie put out, and Lang put out a, a framework for a payments charter, as you know, a federal payments charter. Do you think that is plausible, and what would it take to get something like this in the U.S.?
Oh, a purely payments charter, and I call her Nellie too.
I didn't. No,
a purely payments charter, I think that's much easier. And we have, and you know, there was an attempt at the Fed to do something like that with the 3-tier categorization of access to a master account at the Fed, where, you know, the 3rd tier is you're not a bank, you know, and there are certain things you have to meet. I think we made those criteria overly restrictive in the 3rd tier. The evidence of that may be that so far we haven't really given anything other than a company that picks up pallets of cash and puts it on an airplane access through the 3rd tier, which is not really what was intended to be the innovation of, you know, the support for innovation in the financial system. But, you know, the governors at the Fed were generally much more open to the notion. If you were creating the Federal Reserve today instead of in 1913, you never would have said, oh, this should be the central flywheel only for the banking system. You would have said, this is the central hub of the financial system, and you know, companies that are engaged in financial activities ought to have access to that hub, and depending on what the activity is. So if you're engaged in general banking services, there are certain restrictions that come with that. If you're just engaged in payments, then you ought to have access to that central hub, including the Fed's payment system, on terms that are different than those of a bank. I think that's just very, and the Fed has made efforts to do that. I think those efforts could go farther.
Yeah, I would say we definitely need to be rethinking chartering and expanding chartering, certainly for some kind of payment charter and access, as was discussed in the last panel. And recognizing that banking is getting more and more unbundled in lots of ways. You know, lending is moving to private equity firms. And, you know, the FSOC finally started looking at that after it's been happening for God knows how many years. The other thing I would say, though, about the fintech partnerships is, you know, this is really about all these technological innovations and how do they then get introduced into the banking system? And so you've had, you know, a lot of small companies taking advantage of these various things that have come along, whether it's the ability to process huge quantities of data or smartphones or cloud computing or whatever it is, to come up with some novel services and ways to think about that. And that's all a good thing. And partly because, you know, banks maybe aren't innovating enough on their own. So we need them to do that. And I don't actually get that worried about the number of consent orders that are happening. I mean, truthfully, in a very competitive system where you have a lot of new fintechs coming about and doing things, some are going to be doing a good job and maybe some aren't going to be doing a good job, and the same will be true of banks. And if, you know, regulators need to slap a few hands sometimes, that's okay, as long as we're not crushing, you know, kind of this incentive to innovate. I mean, that's the way it should be. There should be some failures occasionally, but we want to still have a system where people think, yes, it's okay to innovate. I can do that. If I do it responsibly, I'm not going to get, you know, I'm not going to get knocked around by my regulators.
Because we do seem to think sometimes like the pendulum does swing pretty hard one way or the other. And, you know, you have one bankruptcy in the fintech or, you know, space, and all of a sudden it's illustrative of every single of the entire ecosystem. And Raj, you wrote an op-ed that it's not over regulations, it's over supervision sometimes that the banks are facing. Tell us a little bit about like kind of what your perspective on what you were saying in that piece.
I think my central point is that, you know, supervision is unique and it is powerful, and it is uniquely powerful in that it can focus on things in the moment, in darn near real time if you wanted to, and it can focus on issues with a more or less unfettered access to inside data. And you can do so without having to worry about some of the constraints that afflict other regulatory tools. So, for example, enforcement is sometimes totally appropriate, but it is very much a backwards-looking activity, right? Like, for those of you with litigators in your lives, you will notice that they become the world's biggest experts in how a business worked 7 years ago. It's just not that useful in the moment. And in terms of forward-looking, like, notice and comment rulemaking works. 1033 is a live example thereof. But supervision can provide us with a lens on things that simply doesn't exist otherwise. Unfortunately, in my experience, and look, I started a consulting firm some years ago, and I'm a beneficiary of this dynamic. So I note the irony there, but I think that in general, the supervisory process has become too focused on too many issues, including a bunch of issues that are not material to safety and soundness. I think the approach by which we undertake it is way too focused on process as opposed to substance, because regulatory bodies and banks are both, they consist of human beings. When you try to do too many things at once, you for sure are going to miss the forest for the trees. And as a consequence, you end up with something that is too broad, too process focused, way too slow, and that everyone around it kind of acknowledges, well, this doesn't quite feel right, and yet everyone feels sort of powerless to stop it.
Well, how do we change it?
I think it's going to take a couple of things. So one, I should acknowledge, like, of all the people in the nation, like, I probably was best positioned to start a supervisory thing from scratch and develop new habits, and I didn't do it. So I get that irony too. One, it really does take top-down leadership because, again, everyone's they're no bad dogs, right? Everyone's just a human being. And if you have a system in which, like, if you're a line examiner at the FDIC, if a bank fails on your watch, you're going to hear about it. But if everything goes swimmingly, nobody throws you a parade, right? Like, so there's it's an inherent risk aversion that you should expect is going to happen culturally. It's inevitable. And the only way to counteract that is to have a real top-down tone at the institutions themselves that affirmatively seek to change that risk tolerance. I don't think there's any easy way other than that.
That can be hard. Exactly as you stated, I think you have to recognize with respect to the supervisors, these are extremely diligent, very able people who have been told for their entire careers, you can't manage the bank. And who also know that if a bank fails as a result of their non-management of the bank, that they will be held responsible as much as the bank's management. That's an almost impossible task. And as you said, the almost inevitable result of those two incentives of operating in that framework is then I'm going to focus on process I'm going to focus on the process of management. If I can't manage the bank, but I'm supposed to keep it from failing, then I'm going to, then my whole shtick is going to be the bank's management process, as opposed to the obvious risks that are evident at a particular bank. There was, SVB is perhaps, a very good example and very far away from Philadelphia and therefore very safe to speak of here. But there were, I think 33 MRAs and MRIAs at SVB, and really none of them had to do with the central risks that were facing the institution, even though it did not require any particular expertise. It required sort of a spreadsheet, and if you had a flair for the dramatic, a green eye shade to see what was the problem there. But the system has evolved so that, well, if we said you have this glaring interest rate risk and you must fix it, we're now managing the bank. And we can't do that. So what can we do? Well, we can say, well, what's your process? How many committees have considered this question? It's just, it's a very, it's very difficult, but it does, and I think ultimately, the only way it's going to be solved, I tried to begin addressing that. Nobody really understood what I was trying to get at. They thought I was just saying, go easy on the banks, right? And I think just as only Nixon could go to China, only Jimmy Carter could deregulate the airline industry, it may be that only Rod Date can address this issue because I think it's actually, of all the things that we're talking about the most consequential for the financial system right now is this: how do you fix supervision so that it becomes focused on what matters instead of what doesn't?
It's well said. And I think that is really this notion that one should not want a government agency to be dictating private sector strategy. And so you can understand how people slip into saying, well, if it's not substance, it's got to be process.
Well, but Tim, when you were at the CFTC, you were having, I'd love to just get your insights into what it was like with a lot of these emerging technologies coming in, and similar, I assume, for regulators, and especially, those that are on the front lines are saying, not only do I not understand necessarily everything that's happening inside a bank, and I'm told I can't, but now I've got all this emerging technology coming in. I don't understand it. I'm just going to shut it down. I'm just going to say, stop, but you didn't. And you created the innovation lab, and you tried to work, and you tried to bring in these, innovators that were to understand it better. How did you all approach kind of that aspect of this emerging sector?
Well, I actually didn't create the innovation lab. Chris, my successor, did, but we allowed for the innovation in other ways. There are plenty of vehicles by which we could allow for it. The innovation lab was a nice PR thing, but you can do it through no action letters. You can do it through all sorts of things. And the CFTC fortunately has a bit of a culture of recognizing the importance of innovation, just because the markets that it regulates have driven innovation in many, many ways. So we were first out there in terms of cryptocurrencies and trying to do something there, which was declaring virtual currencies to be commodities, but also allowing for Bitcoin swaps and so forth. I only regret that I didn't call up Mary Jo White and say, at the SEC, say, hey, why don't we create a framework for this right now? We missed our moment. But look, it's, again, I think it comes back to we have to develop more of a recognition that innovation is always going to be happening, and we have to constantly kind of recognize that and figure out how to give regulators, a sense of, striking the right balance between allowing it, but still, looking at safety and soundness, and not having their heads chopped off politically, when occasionally maybe something doesn't go quite right.
Yeah, we heard earlier at one of the earlier panels, SEC referred to a bit of the Death Star. Do other regulators look at the other regulators like, "Oh, glad that's not me," or is it like, "Oh, let's shore up what we have"? How do you retreat? When someone is, facing a little bit of an onslaught.
Well, look, I mean, during my time, we had a great relationship with the SEC, and I think we worked very well together. Crypto is kind of a different kettle of fish, if you will, in a way. I mean, look, first of all, let me just say on this, I think I agree with a lot of the enforcement actions that the SEC has taken in the crypto space. There is a huge amount of fraud and manipulation and failure to follow the law. Having said that, I, for a long time, have said, enforcement isn't enough to get us to where we want to be. Now, lots of people have said today we need, clarity and certainty and so forth. Those are nice words, and I don't disagree with those words. It's hard to get there. And if anybody thinks the Financial Innovation and Technology Act, as creative as it is, which is, the bill pending in Congress, is going to bring clarity and certainty, I'm not one of them, because I think it will actually raise a lot of questions. Now, maybe in the long run it will be better, but it takes time. This is a complicated technology, and people refer to it as an asset class. It's really not an asset class. It's really a technology. And sometimes tokens have a use case, and sometimes they're just an investment, and sometimes they're both. And so, how we thread our way through that is difficult. I've put out some proposals that really, are meant to be incremental steps forward as opposed to the final, perfect solution, because I think that's hard to do. So that's the way I would think about, responding to something like crypto is, let's take incremental steps forward that reduce the amount of fraud and manipulation in this sector. Jay Clayton and I have put out some ideas. And by doing that, then, we might, first of all, direct the innovation toward more useful use cases, and then also over time be able to say, well, this is This is the more refined framework that we need, but we can't necessarily just get there all at once.
And one of the other things that we kept hearing today was the U.S. is falling behind. The U.S. is falling behind other jurisdictions, whether it be in faster payments or innovation, tap to pay, or all kinds of things. At the same time, you hear safety, soundness, fairness, safety, making sure that we don't bring in too much risk. And I'm curious, Raj, and everyone's point is the U.S. falling behind? Are we being too slow to respond, too restrictive? Our system is too cumbersome with state and federal, all the different regulations that have to go through. Are we really falling behind?
I'm of sort of two minds about it. Like, on the one hand, we are the biggest economy in the world. We have the best talent reservoir. People still actually do come here for a great opportunity. We have terrific schools and research programs, and we have the rule of law. So I'm not super panicked about it, candidly. Second, our system, broadly speaking, is conservative with a small c for a reason. It's also a democracy, and so when you have a bunch of conflicting interests and various kind of vested, you should expect it to look kind of messy, and you should expect it to look a little slow. That said, I think that right now for crypto, and frankly for a lot of sectors in a post-Chevron world, we're about to be reminded that, Article 1 is Article 1 for a reason. Like, there are some things that really only the legislature can do, and I think we are at that point with crypto.
And what do you think, for all of you, what is the effect of the Looper Chevron doctrine now being overturned? Does it put more onus on the lawmakers to make more prescriptive statutes, or what is the impact that it would be?
Yeah, I think that Congress will have to start doing its job. I mean, that's a bit of a throwaway line, but I do think that the evolution of the administrative agencies over the course of many decades has facilitated an abdication of Congress's ability to act. And like everything, if something has to happen, it will. And if the agencies are no longer able to develop extremely complex regulatory frameworks on the basis of a thread of instruction from the Congress, then the Congress is going to have to engage on making those very clear instructions. Now, in the area of, in many areas around crypto, I think that it's shown that it can, actually. There are other areas that may be more difficult, but just take stablecoins, for example. I mean, the president's working group years ago came out with a very good paper on the principles that ought to govern stablecoin regulation. There have been a couple of legislative proposals out there, bipartisan, that could easily have passed. It's kind of been blocked by one senator and one administrator, and that shouldn't happen. And so I think in a world where the administrative agencies don't have that power and Congress is gradually, brought up with the realization that, oh, we have to do this, that they will, and that will be good for everyone. It will be possible, and it will be a better result.
Yeah. Well, speaking of the one senator, having been a Senate alum where we used to say all good things go to die, so I know that system well, but. Each of you all served, obviously, at the under different administrations. Curious, Tim, you served under Obama. Did you have a divided Congress during your time?
Yeah, we definitely did.
And how was that? I'm curious if you did. What was the difference? Because we're obviously a couple of days, weeks from an election, and we may not have a divided Congress. Curious from each of you all what it was like, and did your roles change?
Well, it matters more, I think, just in terms of the oversight process than it did in terms of legislation, at least under my watch. We were implementing Dodd-Frank, so that had already been adopted, and that was really the focus of our work. But, obviously, Republicans love to take pot shots at us. My favorite was always that we were implementing the swap rules, and I'd go testify, and someone would say, now what's this financial stability board thing that you're going to meetings of, and they seem to be dictating rules for the U.S., and why is that? Aren't we giving up jurisdiction when they're telling us how to implement these swap rules? And I try to answer, well, no, it's just guidance. It's not mandatory. We're just trying to harmonize rules. And then the same person would say, now I'm hearing that the rules we're making are different than the rules overseas. And why haven't you harmonized those? Why isn't there some process for harmonizing those? So, you sort of get it both ways, but, you deal with it and you just move on. Look, in terms of what happens going forward, well, I don't know how much you want to get into that. I'll let the others answer in terms of their historical experience first.
I will share just one anecdote about my time at Treasury when I feel like I was routinely beaten by members in the House in particular during hearings. And before what was going to be an especially contentious hearing, I got a call from one of the senior lawyers over at Treasury whose name was Chris something. They were all named Chris, weirdly. But and he said, listen, you're going to be fine tomorrow. I want you to bear in mind that every single person who's asking you questions has had something like 500,000 people vote for them, and you have not. And I think that is, you got to take a little bit of that reality with it. And I think, frankly, the worst thing about congressional oversight right now is that it did not anticipate the rising of social media, because the quantum leap in grandstanding is almost intolerable to bear.
It began with C-SPAN, but it really.
Well, remember that they used to. Remember, Newt Gingrich changed the camera angle on C-SPAN
yes.
because it used to just show the empty
hall.
Yeah.
It was. You go back in history and you read the minutes of a congressional hearing. It was an entirely different experience in the 30s, 40s, 50s than it is today. But my first tour of duty in public service was in the Bush 41 administration, where we had a democratically controlled Congress and a Republican administration, and it was much different on these issues, right? On the questions of financial regulation. They were political with a little p because there was a lot of money involved, and but they were not political with a big P. And that changed dramatically after the great financial crisis, and it changed dramatically because a handful of politicians discovered that they could make a national reputation. Indeed, one of them ran for president largely on the basis of having passionate views on the precise calibration of the enhanced supplemental leverage ratio. And that has been very, very bad for financial regulation in general.
And do you think it's Raj, back to your point on we are in a democracy. Do you think divided government is good? Do you think it's better when the White House also has 60 votes in the Senate? And can possibly control the House? Which do you think is a better scenario for citizens, for innovation, or for moving the country forward?
I think on balance, I would much prefer that the Senate and the House sort of function irrespective of specific supermajorities, because I sort of believe that if a problem is big enough and you have an institution whose rules suit the modern age, things will get done. Believe it or not, things will, in fact, get done.
Instead of fighting CRs and minibuses, super buses, backed up buses. Yes, understood. Tim, you were going to expand on maybe current climate.
You want me to expand on current climate?
We are going in, and we will have a new
president.
We will also have likely different ratios in the House and Senate. What would be an advice you would give? Well, current chair is probably going to stay current chair, but potentially 2 other new commissioners on the CFTC. What would be your advice.
Look,
Yeah.
it's so unpredictable at this moment. Not simply who wins, but then what happens. I mean, if I may get a little bit political here, if Mr. Trump wins, I have no idea what financial regulatory policy will be. There's nothing about it in the Republican platform. They talk about slashing regulation, but I don't know if that refers to energy or environment or what. And it really depends on who bends his ear at the right time about the right thing. Is it the Project 2025 people who want to eliminate a lot of securities regulation and eliminate FINRA and the PCAOB and maybe curb the independence of the Fed? Is it tech people like Elon Musk, who maybe would be a force for innovation? I don't know, but maybe if he gets into a fight with Peter Thiel, then who knows what happens, because, Thiel supports Vance. Is it the populist element? We don't know. So I think it's very hard to predict where financial regulation goes. And if Harris wins and the Republicans take control of the Senate, which seems likely, what does that mean in terms of appointments? And does she decide that, gee, it's going to be hard to really get the people I want, so I'm going to leave people who are there today in place? There's just so many uncertainties. And financial regulation for either of them, I don't see as a high priority. I think the high priorities are immigration, taxes, the budget, the economy overall. So I can't make any predictions about what's going to happen in terms of financial regulation, no matter who wins.
If you're asking for advice to the new administration, whichever it is, I would say, what we did from 2017 to 2021, be moderate and focused in your ambitions, whoever it is that wins. So we took the view. So when I came into office, I was encouraged by many, many people to strap a flamethrower on my back and just burn it all down. And I said, no, we're not going to do that, because if we focus on some specific issue, we can make some material change that will be, that will be useful refinements that will last, if we approach this, in a very focused manner. Recently, we've seen, a very ambitious bank capital rule be proposed that was not on those lines, that failed. Because, our country is very evenly divided. The Congress is going to be very evenly divided after this election. Whoever wins, whoever is controlling Congress, it's going to be by small margins. And following a program of whichever direction, the executive chooses to push things, to say, well, let's be focused in how we push things in those directions, and to make a strong case for a limited number of changes that will make a difference in what it is that we want to do, whichever direction we want. That will be much more successful and much better for the system than what we've seen recently.
And how much direction do you take from an administration? I know independence is there, but are you, as you're making decisions, are you reading the news, reading tea leaves? Are you kind of taking cues and lessons from what you're seeing and reading on proposed speeches or speeches coming up, or what has been said, or directives? Like, how much are you watching, or you've got your mandate from your agency and that's what you're going forward with?
I think I had a slightly different disposition on that particular question than maybe some of my successors, who I'm sure all of whom have been more effective and talented than I. And indeed, if you were to Google or use Bing to my name and Dick Durbin's, you'll find a photograph of him yelling at me in his office after, I think it was like, I can't remember what bank it was. Let's call it Bank of America. Rolled out like a $5 a month, checking account. And I'm pretty familiar with the economics of like what it costs to run a checking account. Actually, I thought, well, that seems like a pretty good deal to me. And the senator did not agree and made that very clear. In any case, look, the reason I view the role of independent regulators as to try to be independent, especially in a field like this one, where near-term decisions can really impact medium and long-term effects on the economy and on actual living people in ways that you can't necessarily predict if you are being too quick and too responsive to whatever the political winds of the moment happen to be.
Yeah, I mean, look, I agree with what Raj and Randy have said. I mean, we need to try to lessen the politicization of financial regulatory policy so that we have somewhat more consistency over time. That's obviously better for innovation. It's better for investment. It's better for stability. In terms of, advice from the administration, I didn't really get any because, Dodd-Frank had been passed. That was the mandate. That was the agenda. I think it is challenging, though, because we do have this fragmented system, and you do have these separate regulators, and they are kind of supposed to do their own thing, yet, increasingly, the issues we face are ones that cut across the system or implicate more than one regulator. And, that fragmented system that we set up was defined on product lines, on certain types of entities, and it just doesn't reflect fully the reality that we have today. So how do you kind of deal with the fact that you've got a system where what's happening is cutting across these jurisdictional boundaries on the one hand. On the other hand, the White House, isn't supposed to be directing what the independent regulators do. Certain regulators have more, are more under the OCC is, part of the Treasury and so forth. That's a very hard thing, I think, for an administration to get right. But I do think the key to it is obviously the people you appoint, getting people who come at it with both knowledge and kind of a moderate view, not extreme on either side, and lessening, if we can, somehow, this over-politicization of a lot of these issues.
As we set up the next 5 years, 10 years of the future of finance, of how we're only going to become more digitized, we're only going to be using our phones more, we're only going to be, going less paper. And what would be, and I'll go through each of you, what is the one thing or two things that you think the U.S. must address, and take it from your perspective of federal, from the Federal Reserve, from the CFPB, from CFTC, what is the one or two things that they have to get right in the next 2 to 4 years?
In the area of financial regulation.
Go for it.
For me, a central question that has not sufficiently been addressed, there's been a lot of thought about it, but I think that must be addressed as a policy matter, is finding a way to, harmonize is perhaps not the right word, but to rationalize the macro-prudential regulation of banks and non-banks. And the FSOC was intended to be a mechanism for doing that. It's a completely non-functional mechanism. There are way too many people there. You don't need the insurance regulator from Tennessee to decide, in any of this. During my time, I think it still continued after the FSOC meetings. There would be sort of a rump group that would meet in the Treasury's conference room to discuss things, but it didn't really have statutory authority. I think you need to, and there are different approaches. The bank regulators, have an approach that focuses on increasingly rigorous regulation of increasingly large institutions. And that really is not the right approach for most of the non-banking system. That requires a different approach, and we have not harmonized the thinking across that. The FSOC has not done a good job of even creating the intellectual framework to think about how do you create a single macroprudential system across those two different areas of what is an integrated financial system. And I think that's an important intellectual and practical topic that really has to be addressed in the next 5 years.
I'm going to let you in on a little secret. And the secret is things are pretty good right now, right? The sector is actually doing quite well. When I started my firm, it felt like a perfect moment to do so because, credit was unbelievably benign. Rates were basically zero. Everything was kind of working. And the amazing thing is credit is still quite benign. Like things are pretty good. And when things are pretty good, it's a good moment to focus on stuff that isn't urgent, but is very, very important. So let's pick one or two really, really important things that we know to be broken and try to fix them. So here's an example. Today, the rate of African-American home ownership in the U.S. is, I believe, the gap between white and black home ownership is bigger now than it was before the Fair Housing Act was passed. I know that sometimes it feels bad to feel ashamed, but we should be ashamed about that. This is obviously not working. So maybe we should work on stuff that's difficult. And let's not get carried away with chasing, matters that appear to be urgent, but instead to focus on one or two that are important.
Well, I would say a couple things. One I think is recognizing that technology and competitive forces are causing an unbundling of banking. And how does the system respond to that? How do we allow for there to be payments companies that have access to the federal payment infrastructure, but we still ensure the safety of that and the soundness of that? How do we allow for this movement? Not really a question of allowing it. It's already happening. This movement of credit outside of the banking system, what are the implications of that? So we need to be sort of thinking about that just general matter of unbundling. Secondly, I would agree with Raj on not just the housing issue, but just the general equity issues. There was talk about the underbanking population in the last panel, which is high. And for a country as rich as ours and as sophisticated as ours is, having 17% of the population being classified as underbanked, and of course another 5 or 6% unbanked, I think is a big deal. And when you couple that plus the challenges of home ownership, I think we do need to be thinking about these issues of equity. Now, those aren't necessarily immediately the financial regulators' jobs, but I think how we think about the financial system makes a difference there. Certainly in terms of modernizing the payment system would help. I mean, the last panel talked about the problems that people who are underbanked face, people who live paycheck to paycheck face when their check isn't cashed quickly. So, that is something that we should be able to do. Lots of countries have improved their payment systems, and it doesn't necessarily require blockchain. Maybe blockchain is a solution, maybe not, as we heard in an earlier panel. But it does require changes in the law and changes in our regulations to bring that about. So that's another one.
And do you think that, one of the things that we, try to encourage, because what I was saying earlier is that oftentimes new means scary, and let's pause and hold. But do you think that or how do you get to a shift in regulators' approach to say, oh, something new, it must be filling a vacuum, or there must be a gap. Let's see how we can help to put the regulations around to propel it instead of prevent it. Is that a mindset that you see capable of, or is just regulators are going to view it just completely different?
I would probably focus on taking an intermediate cultural step, which is that most things that are new don't matter. Most new stuff just doesn't work. And so I would probably not get wrapped around the axle about every little innovation that appears to happen, because even if it doesn't work, doesn't much change anybody's lives. And by contrast, giving yourself a little bit of lead time to figure out, okay, well, as you start to see the trajectory of something manifest, then you can figure out what is a sensible way to put curbs on ways in which things might go wrong. But being hyper reactive in the moment, to me, feels like a recipe for kind of the wrong and slow outcomes.
I'm still recovering from the fact when you said new means scary, so we have to pause. I thought you said new meets Gary, so we have to pause.
It's not a dating show.
And so I think I would agree with Raj, but it really does depend on it depends on the leadership that's appointed at the institutions, really making that a priority, because the institutional behavior as a whole is never really going to sort of enthusiastically adapt to innovation for all the reasons that we've talked about. Their incentives are entirely otherwise.
And with just a few minutes left, just we'll end up on a happy note, and just would love to hear what was the one either policy or initiative, something that you got through your particular agency that you're most proud of?
Probably striking an agreement with Europe on equivalence of oversight of clearinghouses, because the whole derivatives market was about to blow up had we not achieved that. Of course, it was kind of ironic that we really had a struggle with Europe over that, and then I could only be amused by the fact that then Brexit happened and they had their own struggle with London over that. So that, and I think, harmonizing a lot of the Dodd-Frank measures, because the whole swaps regulatory framework that we implemented post Dodd-Frank was very, very difficult to get done. And of course, the industry was worried about, the rules are going to be inconsistent. But we actually did manage to harmonize a lot of those rules, particularly rules about margin, about clearing, and that market is, functioning pretty well.
There were a bunch of substantive things that mattered during that time, but I guess the thing that I actually am the most proud of is that we managed. When I showed up at Treasury, we had 12 people focused on CFPB implementation. By the time I left, we had 1,200, and getting people to do the decidedly day-to-day unsexy work of financial regulation and making sure that they're great and committed people takes some real work. And I think I commend that whole early team for making it happen. As I said to everybody at the time, and hopefully they still feel it, your only wasting asset is your time. And so you ought to spend it on things that matter, and you should spend it on things where you can make a difference and where you might have some success. And I think that for the most part, we did that.
Yeah, I would say certainly of my time at the Fed, it was the tailoring rule, which was again, as I said, I think that was well supported. It was a difficult logistical thing to get through, and I think that the fundamental theory behind it, which was if we don't burn it all down, the changes we make will last. There was a period there where people were saying, "See, we told you so. You should have burned it all down." And I think we're seeing that approach has been vindicated.
Well, thank you all for staying. I know we stand between you and cocktails. So, but to repeat, Raj, the future is bright. We better wear sunglasses. Thank you all.